as14 Accounting for amalgamations. This accounting standard includes paragraphs set in bold italic type and plain type which have equal authority. Paragraphs in bold italic type indicate the main principle. This accounting standard should be read in context of preface to statements of accounting standards and the applicability of accounting standards to various entities. Introduction. This standard deals with accounting for amalgamations and their treatment of any resultant goodwill or reserves. This standard is directed principally to companies, although some of its requirements also apply to financial statements of other enterprises. This standard does not deal with cases of acquisitions which arise when there is a purchase by a one company referred to as acquiring company on of the whole or part of shares or the whole or part of assets of other company referred to as acquired company in consideration of in consideration for payment in cash or by issue of shares and or other securities in acquiring company or partially in one form and partly in the other. The distinguishing features of an acquisition is that the acquired company is not dissolved or its separate entity continues to exist. Definitions. The following terms are used in this standard with the meanings specified. Amalgamation means an amalgamation pursuant to the provisions of the Companies Act 1956 or any other statute which may be applicable to companies. Transferor company means the company which is amalgamated into another company. Transferee company means the company into which a transferor company is amalgamated. Reserve means the portion of earnings, receipts or other surplus of an enterprise, whether capital or revenue, appropriated by the management for a general or specific purpose other than provision for depreciation or diminution in the value of asset or for a known liability. Amalgamation in the nature of merger is a amalgamation which satisfies all the following conditions. All the assets and liabilities of the transferor company become after amalgamation the asset and liabilities of the transferee company. Shareholders holding not less than 90% of face value of the equity shares of the transferor company other than the equity shares already held therein immediately before the amalgamation by the transferee company or its subsidiary and their nominees become equity shareholders of the transferee company by virtue of the amalgamation. Issued in 1994, a limited revision to this standard was made in 2004 pursuant to which paragraph 23 and 42 of this standard were revised. Attention is specifically drawn to paragraph 4.3 of the preface, according to which accounting standards are intended to apply only to those items which are material. The consideration for the amalgamation receivable by those equity shareholders of the transfer company who agree to become equity shareholders of the transferee company is discharged by the transferee company wholly by the issue of equity shares in the transferee company, except that cash may be paid in respect to any fractional shares. The businesses of the transferor company is intended to be carried on after the amalgamation by the transferee company. No adjustments is intended to be made to the book value of the assets and liabilities of the transferor company where when they are incorporated in the financial statements of the transferee company except to ensure uniformity of accounting policies. Amalgamations in the nature of purchase is an amalgamation which does not satisfy any one of the following conditions specified in subparagraph E above. Consideration for an amalgamation means the aggregate of the shares and other securities issued and the payment made in the form of cash or other assets by the transferee company to the shareholders of the transferor company. Fair value is the amount for which the asset could be exchanged between a knowledgeable willful buyer and a knowledgeable willful seller in an arm's length transaction. Pooling of interest is a method of accounting for amalgamations, the object of which is to account for the amalgamation as if the separate businesses of the amalgamating companies were intended to be continued by the transferring company. Accordingly, only minimal charges are made in aggregating the individual financial statements of the amalgamating company. Explanation. Type of amalgamation. Generally speaking, amalgamations fall in two broad categories. In first category are those amalgamations where there is a genuine pooling not merely of assets and liabilities of the amalgamating company but also the shareholders' interest of the businesses of these companies. Such amalgamations are amalgamations which are in the nature of merger, and the accounting treatment of such amalgamations should ensure that resultant figures of assets, liabilities, capital, and reserves more or less represent the sum of the relevant figures of the amalgamating companies. In the second category are those amalgamations which are in effect a mode by which one company acquires another company, and as a consequence the shareholders of the company which is acquired normally do not continue to have a proportionate share in the equity of the combined company or the businesses of the company which is acquired is not intended to be continued. Such amalgamations and amalgamations are amalgamations of in the nature of purchase. An amalgamation is classified as amalgamation in the nature of merger when all the conditions listed in paragraph 3e are satisfied. However, there are different views regarding the nature of any further conditions that may apply. Some believe that in addition to an exchange of equity shares, it is necessary that shareholders of transferor company obtain a substantial share in transferee company, even to the extent that it should not be possible to identify any one part as dominant therein. This belief is based in part of views that exchange of control of one company for the insignificant share in a larger company does not amount to mutual sharing at risk of risks and benefits. Others believe that substance of amalgamation in the nature of merger is evidenced by meeting certain criteria regarding the relationship of the parties, such as the former independence of amalgamating companies, the manner of their amalgamation, the absence of planned transactions that would undermine the effect of amalgamation, and the continuing participation by the management of the transferor company in the management of the transferee company after the amalgamation. Method of accounting of amalgamation. There are two main methods of accounting of amalgamation: the pooling of interest method and the purchase method. To use the pooling of interest method is confined to circumstances which meet the criteria referred to paragraph 3e for an amalgamation in the nature of merger. The object of purchase method is to account for an amalgamation by applying the same principle as are applied in the normal purchase of assets. This method is used in accounting for amalgamations in the nature of purchase. The pooling of interest method. Under the pooling of interest method, the assets, liabilities, and reserves of the transferor company are recorded by the transferee company at their existing carrying amounts after making the adjustments required in paragraph 11. If at the time of amalgamation the transferor and the transferee company have conflicting accounting policies, a uniform set of accounting policy is adopted following the amalgamation. The effect of on the financial statement of any changes in accounting policies are reported in accordance with accounting standard AS5. Net profit or loss for the period, prior period items, and changes in accounting policies. The purchase method. Under the purchase method, the transferee company accounts for the amalgamation either by incorporating the assets and liabilities at their existing carrying amounts or by allocating the consideration to the individual identifiable assets and liabilities of the transferor company on the basis of their fair value at the date of amalgamation. The identifiable assets and liabilities may include assets and liabilities not recorded in the financial statement of the transferor company. When assets and liabilities are restated on the basis of their fair values, the determination of fair values may be influenced by the intentions of the transferor company. For example, the transferee company may have been a specialized use of an asset which is not available to other potential buyers. The transferor company may intend to effect changes in the activities of transferee company which necessitate the creation of specific provisions for of the expected cost, for example planned employee termination and plant reallocation cost. Consideration. The consideration of the amalgamation may consist of security, cash or other assets. In determining the value of the consideration, an assessment is made of the fair value of its elements. A variety of techniques is applied at arriving a fair value. For example, when consideration includes securities, the value fixed by the statutory authorities may be taken to the fair value. In case of assets, the fair value may be determined by reference to market value or the asset given up. When the market value of assets given up cannot be reliably assessed, such assets may be valued at their respective net book value. Many amalgamations recognize that adjustments may have to be made to the consideration in the light of one or more future events. When the additional payment is probable, can reasonably be estimated at the date of amalgamation. It is included in the calculation of consideration. If in all other cases, the adjustment is recognized as soon as the amount is determinable. See accounting standard As4 contingency and events occurring after balance sheet date. Treatment of reserves on amalgamation. If the amalgamation is an amalgamation in the nature of merger, the identity of reserve is preserved and they appear in the financial statements of the transferee company in the same form in which they appeared in the financial statements of the transferor company. Thus, for example, the general reserve of the transferor company becomes the general reserve of the transferee company. The capital reserve of the transferor company becomes the capital reserve of the transferee company, and the revaluation reserve of the transferor company becomes the revaluation reserve of the transferee company. As a result of preserving the identity reserves which are available for distribution as defined before the amalgamation would also be available for distribution as dividend after the amalgamation. The difference between amount recorded as share capital issued plus any additional consideration in the form of cash and or other assets and the amount of share capital of the transferor company is adjusted in reserves in the financial statements of the transferee company. If the amalgamation is an amalgamation in the nature of purchase, the identity of reserve other than the statutory reserve deals with in paragraph 18 is not preserved. The amount of consideration is deducted from the value of the net assets of the transferor company acquired by the transferee company. If the result of the computation is negative, the difference is debited to goodwill arising of amalgamation and deal with in the manner stated in paragraph 19 to 20. If the result of computation is positive, the difference is credited to capital reserve. Certain reserves may have been created by the transferor company pursuant to the requirements of or to avail the benefits under the Income Tax Act 1961. For example, Development Allowances Reserve or Investment Allowances Reserve. The Act requires that the identity of the reserve should be preserved for a specified period. Likewise, certain other reserves may have been created in the financial statements of the transferor company in terms of requirements of other statutes. Through normally in an amalgamation in the nature of purchase, the identity of reserve is not preserved. An exception is made in respect of reserves for of the aforesaid nature referred to hereby as statutory reserve, and such reserves retain their identity in the financial statements of the transferor company in the same form in which they appeared in the financial statements of the transferor company, so long as their identity is required to be maintained to comply under the relevant statute. This exception is made only to those amalgamations where the requirement of relevant statute for recording the statutory reserves in the book of transferee company are complied with. In such cases, the statutory reserves are recorded in the financial statements of the transferee company by a corresponding date to suitable account head. For example, amalgamation adjustment account, which is disclosed as a part of miscellaneous expenditure or other similar category in the balance sheet, when the identity of statutory reserve is no longer required to be maintained. Both reserves and the aforesaid account are reversed. Treatment of goodwill arising out on amalgamation. Goodwill arising on amalgamation represents a payment method in anticipation of future income, and it is appropriate to treat it as an asset to be amortized to income on systematic basis over its useful life. Due to the nature of goodwill, it is frequently difficult to estimate its useful life with reasonable certainty. When such estimation is therefore made on a prudent basis, accordingly, it is considered appropriate to amortize goodwill over a period not exceeding 5 years unless a somewhat longer period can be justified. Factors which may be considered in estimating the useful life of goodwill arising on amalgamation include the foreseeable life of business or industry, the effects of product obsolescence, changes in demand and other economic factors, the service life expectancies of key individuals or groups of employees, expected actions by competitor or potential competitors, and legal, regulatory or contractual provisions affecting the useful life. Balance of point Balance of profit and loss account. In case of amalgamation, in the nature of merger, the balance of profit and loss account appearing in the financial statements of the transferor company is aggregated with the corresponding balance appearing in the financial statements of transferee company. Alternatively, it is transferred to the general reserve if any. In case of an amalgamation in the nature of purchase, the balance of profit and loss account appearing in the financial statements of the transferor company, whether debit or credit, loss its identity, loses its identity. Treatment of reserves specified in a scheme of amalgamation. The scheme of amalgamation, sanctioned under the provision of Companies Act 1956 or any other statute, may prescribe the treatment to be given to the reserves of the transferor company after its amalgamation. When the treatment is so prescribed, the same is followed. In some cases, the scheme of amalgamation sanctioned under a statute may prescribe a different treatment to be given to reserves of the transferor company after amalgamation as compared to the requirements of this standard that would have been followed had no treatment been prescribed by the scheme. In such cases, the following disclosures are made in the first financial statements following the amalgamation. A description of accounting treatment given to the reserve and the reasons for following the treatment different from that prescribed in this standard. Deviations in the accounting treatment given to the reserve as prescribed by the scheme of amalgamations sanctioned under the statute as compared to the requirements of this standard that would have been followed had no treatment been prescribed by this scheme. The financial effect, if any, arising due to such deviation. Disclosure. For the amalgamations, the following disclosures are considered appropriate in the first financial statement following the amalgamation. Names and general nature of businesses of the amalgamating companies, effective date of amalgamation for accounting purposes, the method of accounting used to reflect the amalgamations, and particular of scheme sanctioned under the statute. For amalgamation accounting under the pooling of interest method, the following additional disclosures are considered appropriate in the first financial statements following amalgamation. Description and number of shares issued together with the percentage of each company's equity shares exchanged to the to effect the amalgamation. The amount of difference between the consideration and the value of net identifiable assets acquired and the treatment thereof. For amalgamations accounted for under the purchase method, the following additional disclosures are considered appropriate in the first financial statements following the amalgamation. Consideration for the amalgamation and a description for the consideration paid or contingency payable, and the amount of any difference between the consideration and the value of net identifiable asset acquired and the treatment thereof, including the period of amortization of any goodwill arising on amalgamation. Amalgamation after the balance sheet date. When the amalgamation is effected after the balance sheet date, but before the issuance of the financial statements of either party to the amalgamation, disclosure is made in accordance with as4. Contingency and events occurring after the balance sheet date, but the amalgamation is not incorporated in the financial statements. In certain circumstances, the amalgamation may also provide additional information affecting the financial statements themselves, for instance, by allowing the going concern assumptions to be maintained. Main principles. An amalgamation may either be an amalgamation in the nature of merger or an amalgamation in the nature of purchase. An amalgamation should be considered to be amalgamation in the nature of merger when all the following conditions are satisfied. All assets and liabilities of the transparent company become, after amalgamation, the assets and liabilities of the transferee company. Shareholder holding not less than 90% of the face value of equity share of the transferor company other than the equity share already held therein immediately before the amalgamation by the transferring company or its subsidiaries or their nominees become equity shareholders of the transferring company by virtue of a amalgamation. The consideration of the amalgamation receivable by those equity shareholders of the transferor company who agree to become equity shareholders of the transferring company is discharged by the transferring company wholly by the issue of equity shares in the transferring company, except that cash may be paid in respect of any fractional shares. The businesses of the transferor company is intended to be carried on after the amalgamation by the transferring company. No adjustment is intended to be made to the book value of the assets and liabilities of the transferor company when they are incorporated in the financial statements of the transferee company, except to ensure uniformity of accounting policies. An amalgamation should be considered to be an amalgamation in the nature of purchase when any one of or more of the conditions specified in paragraph 29 is not satisfied. When an amalgamation is considered to be an amalgamation in the nature of merger, it should be accounted for under the pooling of interest method described in paragraph 33 to 35. When an amalgamation is considered to be an amalgamation in the nature of purchase, it should be accounted under the purchase method described in paragraph 36 to 39. The pooling of interest method. In preparing the transferee company's financial statements, the assets, the liabilities and reserves, whether capital or revenue or arising on revaluation of the transferor company, should be recorded at their existing carrying amounts and in the same form as at the date of amalgamation. The balance of the profit and loss account of the transferor company should be gated with the corresponding balance of the transferee company or transferred to the general reserve if any. If at the time of amalgamation the transferor and the transferee companies have conflicting accounting policies, a uniform set of accounting policies should be adopted following the amalgamation. The effects of the financial statements of any change in accounting policies should be reported in accordance with Accounting Standard AS5. Net profit or loss for the period, prior period items, and changes in accounting policies. The difference between the amount recorded as share capital issued plus any additional consideration in the form of cash or other assets and the amount of share capital of the transferor company should be adjusted in reserve. The purchase method. In preparing the transferee company's financial statements, the assets and liabilities of the transferor company should be incorporated at their existing carrying amounts, or alternatively, the consideration should be allocated to the individual identifiable assets and liabilities on the basis of their fair value at the date of amalgamation. The reserves, whether capital or revenue or arising on revaluation of the transferor company other than the statutory reserves, should not be included in the financial statements of the transferee company except as stated in paragraph 39. Any excess of the amount of consideration over the value of the net assets of the transferor company acquired by the transferee company should be recognized in the transferee company's financial statement as goodwill arising on amalgamation. If the amount of the consideration is lower than the value of net assets acquired, the difference should be treated as capital reserve. The goodwill arising on amalgamation should be amortized to income on systematic basis over its useful life. The amortization period should not exceed 5 years unless somewhat longer period can be justified. When the requirements of relevant statute for recording the statutory reserves in the book of the transferee company are compiled with, the statutory reserve of the transferor company should be recorded in the financial statements of the transferee company. The corresponding debit should be given to suitable account head, for example, amalgamation adjustment account, which should be disclosed as a part of miscellaneous expenditure or other similar category in the balance sheet. When the identity of statutory reserve is no longer required to be maintained, both the reserves and the aforesaid account should be reversed. Common procedure. The consideration for the amalgamation should include any non-cash element at fair value. In case of issue of securities, the value fixed by statutory authorities may be taken to be the fair value. In case of other assets, the value may be determined by reference to the market value of the assets given up. When the market value of the assets given up cannot be reliably assessed, such assets may be valued at their respective net book value. When the scheme of amalgamation provides for an adjustment to the consideration contingent on one or more future events, the amount of additional payment should be included in the consideration if payment is probable and reasonable estimate of the amount can be made and a reasonable estimate of the amount can be made. In all such cases, the adjustment should be recognized as soon as amount is determinable. See Accounting Standard AS4 Contingency and event occurring after the balance sheet date. Treatment of reserves. specified in a scheme of amalgamation. When the scheme of amalgamation sanctioned under a statute prescribes the treatment to be given to the reserves of the transferor company after amalgamation, the same should be followed. When the scheme of amalgamation sanctioned under a statute prescribes a different treatment to be given to the reserves of transferor company after amalgamation as compared to the requirement of this standard that would have been followed had no treatment been prescribed by the scheme. The following disclosure should be made in first financial statement following the amalgamation. A description of accounting treatment given to its reserves and reasons for following the treatment different from that prescribed in the standard, deviation in the accounting treatment given to the reserve as prescribed by the scheme of amalgamation sanctioned under the statute as compared to the requirement of this standard that would have been followed had no treatment been prescribed by the scheme. The financial effect, if any, arising due to such deviation. Disclosure. For all the amalgamations, the following disclosures should be made in the first financial statement following the amalgamation. Names and general nature of the businesses of the amalgamating companies, effective date of amalgamation for accounting purposes, the method of accounting used to reflect the amalgamation and particular of the scheme sanctioned under a statute for amalgamation is accounted for under the pooling of interest method. The following additional disclosures should be made in the first financial statements following the amalgamation: description and number of shares issued, together with the percentage of each company's equity shares exchanged to effect the amalgamation, any amount to any difference between the consideration and the value of net identifiable assets acquired and the treatment thereof, for amalgamations accounted for under the purchase method. The following additional disclosures should be made in the first financial statements following the amalgamations: consideration for the amalgamation and a description of the consideration paid or contingency payable, and the amount of any difference between the consideration and the value of net identifiable assets acquired and the treatment thereof, including the period of amortization of any goodwill arising on amalgamation. Amalgamation after the balance sheet date. When an amalgamation is effected after the balance sheet date but before the issuance of financial statements of either party or to the amalgamation, disclosure should be made in accordance with as14. Contingencies and events occurring after balance sheet date, but the amalgamation should not be incorporated in the financial statements. In certain circumstances, the amalgamation may also provide additional information affecting the financial statements themselves, for instance, by allowing the group going concern assumption to be maintained.